StockViews.com, the community for serious investors. In 1964, Warren Buffett took control of a company called Berkshire Hathaway, back when it was still a small textile company. The book value of Berkshire at that time was around $19. By the end of 2012, Berkshire's book value had grown to $114,214. That represents a staggering gain of over 500,000%, including dividends.
Hey, I think it's probably worth listening to what this guy has to say.
Warren Buffett shuns Wall Street. For the most part, he thinks it's a crock. Professionals who are so wrapped up in financial theory, they've forgotten what it means to be an investor. He lives in Omaha, Nebraska, far away from the madness and incessant noise of financial markets. For this reason, he is often referred to as the Sage of Omaha.
Sweet home Omaha, where the skies are so blue. Sweet home Omaha, Lord, I'm coming home to you.
Each year, Warren Buffett holds the annual shareholder meeting of Berkshire Hathaway in Omaha. Warren imparts some words of wisdom, a few folk ask some questions, and sometimes Warren plays us a tune on his ukulele. He calls it Woodstock for capitalists.
Man, these cash flows are far out.
Lesson 1. Price and value. It's important to understand the difference between price and value. Price is what you pay.
Value is what you get.
To be a successful investor, you need to ensure that the price you pay is lower than the value you get. You'll often hear Buffett say things like, "I'm buying $1 for 50 cents." This is what he means. But how do you determine the value of a share? Buffett puts a lot of effort into determining what he calls the intrinsic value. Many people see Buffett as a value investor, but he rejects this term. He thinks it's nonsense to divide the world into value and growth. He says, in our opinion, the two approaches are joined at the hip. Growth is always a component of value, constituting a variable whose importance can range from negligible to enormous. In addition, we think the term value investing is redundant. What is investing if it's not the act of seeking value at least sufficient to justify the amount paid? Buffett says the only way to determine intrinsic value is to discount future cash flows to the present day using an appropriate discount rate. The value of any stock, bond, or business today is determined by the cash inflows and outflow, discounted at an appropriate interest rate that can be expected to occur during the remaining life of that asset.
Of course, a discounted cash flow can easily go wrong because it involves an estimation of future cash flows, which are inherently uncertain. Buffett has two answers to this. Firstly, you should stick to businesses that you understand and which are simple and stable in character. Secondly, you should insist on a margin of safety. This means you make sure there is a large gap between what you think the value is and the price you pay. This is something that Warren Buffett learned from his mentor, Benjamin Graham, and you'll hear him talk about this concept a lot. Lesson 2. Find a great company.
This is what Warren has to say about finding a great company. Your goal as an investor should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you'll find only a few companies that meet these standards. So when you see one that qualifies, you should buy a meaningful amount of stock. Warren warns us again not to put our faith in modern finance theory. To invest successfully, you need not understand beta, efficient markets, modern portfolio theory, option pricing, or emerging markets. You may in fact be better off knowing nothing of these.
In order to protect and grow returns, a company must have a durable competitive advantage. Buffett is obsessive about finding companies which are able to sustain high returns. He thinks of a good company as a castle that can be defended by a wide investment moat.
A truly great business must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns.
Nah, 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 you can't get me.
Buffett uses the example of Coke and Gillette to illustrate his point about investment moats. No sensible observer, not even these companies' most vigorous competitors, assuming they are assessing the matter honestly, questions that Coke and Gillette will dominate their fields worldwide for an investment lifetime. Indeed, their dominance will probably strengthen.
Lesson 3. Take advantage of Mr. Market. Use market fluctuations as your friend. Profit from market volatility. Don't participate in it. Mr. Market is a concept that was introduced to Warren Buffett by his mentor, Benjamin Graham. It's a way of thinking about how we can use market volatility to our own advantage. Imagine market quotations as coming from a remarkably accommodating fellow named Mr. Market, who is your partner in a private business.
Hello, I'm Mr. Market.
Without fail, Mr. Market appears daily and names the price at which he will either buy your interest or sell you his.
Even though the business that the two of you own may have economic characteristics that are stable, Mr. Market's quotations will be anything but. For, sad to say, the poor fellow has incurable emotional problems.
At times, Mr. Market feels euphoric, like he's on top of the world and nothing can touch him. At these times, he will buy or sell a stake in the business at a high price because he can see nothing but good times ahead.
I know you want it. I know you want it. You're a good girl. Can't let it get past me.
At other times, Mr. Market gets very depressed and can only see the bad things affecting the business. At these times, he will buy or sell a stake in the business at a very low price.
Well, I'm just great. I can just find.
It's all over.
Mr. Market has another endearing characteristic. He doesn't mind being ignored. If this quotation is uninteresting to you today, he will be back with a new one tomorrow. Transactions are strictly at your option.
Aw, this business is done for, you know. I'll buy your steak for $100, I guess.
Whatever.
Okay, see you tomorrow.
Mr. Market is there to serve you, not to guide you. It is his pocketbook, not his wisdom, that you'll find useful. If he shows up someday in a particularly foolish mood, you're free to either ignore him or take advantage of him, but it will be disastrous if you fall under his influence. Indeed, if you aren't certain that you understand and can value your business far better than Mr. Market, you don't belong in the game.
Let's look back at the key points from today's lesson.
1. Remember the difference between price and value. Always try to pay less than you think the business is worth and look for a big margin of safety.
2. Look for companies that can defend and grow their profits over time. Look for a wide investment moat.
3. Make sure you take advantage of Mr. Market's mood swings. Profit from market volatility rather than participate in it.
We hope you enjoyed this short introduction to Warren Buffett. If you're interested to find out more, there are plenty of books you can read on the subject, including The Essays of Warren Buffett, which does a great job of summarizing his philosophy in an easy-to-understand way. There's plenty more to learn about the man than we can cover here.
StockViews.com, the community for serious investors.